The entire ecosystem that needs to be developed simultaneously. Therefore, we are looking at it from a deconstruct from, and each segment or component is very interesting from an investment standpoint.
Because they are farmers who are economically weak most of the time. What financing does is really to make it affordable and more accessible. I remember there's one case of one specific farmer who was supported through this with just initially using one solar dehydrator. She then had more income to actually start installing more sorts of off-grid solar on her own, so that her house was powered better. So it becomes this sort of like cycle wherein more additions can happen. But for us, it really starts from the root that how can you increase livelihoods by also matching this, so that they then have the capacity to actually access things more. So
I think I read it somewhere that the affordability and accessibility of the finances would really define that in our transition towards, a low carbon economy or a climate resilient economy, the inequality gap will actually widen up or it will close.
absolutely. If you look at we run behind this number very often about how our per capita emissions is like a quarter of the world's emissions. You break that on in income segments. India's top earning population is like 9 times more than what the lowest income is, and that's easily, I think, 4 or 5 times above the global average.
Hello, everybody. Welcome back to another amazing episode of the Climapreneur Show. On Climapreneur, we have always tried to cover a wide range of topics when it comes to climate change, when it comes to sustainability. And today, I feel really honored to be partnering with one of the best organizations, Institute for Sustainable Communities, also known as ISC. So ISC and Climapreneur is partnering to bring to you a series of episodes that will be themed around equitable decarbonization. Equitable decarbonization, what does it mean? To me, equitable decarbonization is that whenever we are building climate solutions, whenever we are looking to decarbonize, how are we going to involve all the sections of society? How are we going to make it inclusive for everyone, regardless of the gender, the age, the financial background? How are our solutions going to help each one of us prosper in their lives? On today's episode, we are being joined by Shravan from Climake and Karann from EV2 Ventures. With them, we really try to understand that what does investing in the climate space look like, the climate investor landscape. Welcome Shravan and Karan on the Climapreneur Show. So, today we would really like to break down that what does the climate investment space looks like and how is this space evolving, particularly from the Indian context. And you two are like an interesting combination here today because Karan, you bring like lots of expertise specifically in the EV sector and the smart mobility sector as we call it. And Shravan has been playing, in all the sectors, to be honest. And like the way you're working with farmers, I think that is a story that I'm waiting for to be revealed. So welcome guys, and to start with, please explain Karo ki what work do you do. Let's start with Karan and then Shravan can follow.
Sure. I run a venture fund called EV2 Ventures that primarily focuses on investing in smart mobility in India, defined as anything that helps move people and things and the technologies around it. And electric vehicles is a very key component, or let's say a segment for our fund. We've backed a few companies in this space, and we will continue to back companies in this space, believing that the electric vehicle ecosystem, or let's say electric vehicles, is the future of mobility.
What about you, Shravan?
So I'm the co-founder of a platform called Climake, and briefly speaking, we are a growth platform which looks to increase access to finance for climate startups. And we do this in multiple ways because one of the things we realized is requires a very collaborative effort. And because we also look at spaces which are emerging, think agri-tech, circular economy, decarbonization industrially, and adaptation, there's a lot of sort of lining your ducks in the row, getting stakeholders on board, really making and demonstrating what has to be done, and also helping to support that process. So we do investment advisory. We also have our own pilot funds specifically focused on debt, with which we're trying to do something different with debt, which we think is a very important instrument. And we also do a lot of thought leadership and advocacy focused on different types of funders, like from DFIs to VC funds, to sort of get them to think a bit about how they could really approach the VC space in the climate space from at least the perspectives that we have, which comes a lot from working core in sustainability and climate for quite a while.
So when are you guys going to be unicorns in your specific companies? I know you are driving that growth for many startups, like with Karan as well and you as well. But when are you guys going to be unicorns individually?
So personally, for us, we look at ourselves as enablers. We don't really look at ourselves as, and one of the places we decided to focus upon is that early stage, where we look at organizations which are really looking at making their first or second any sort of external raise, and in that space, the amount of time which you take to actually get them to a certain level is a lot. So I think when we started this out, me and my co-founder Simi, we never went into it thinking that we're going to become unicorns through this. But it's just a really challenging and interesting area we like. But we felt it's very critical because this is the foundation, the platform around which entire sectors can be built. So that's really what we are attacking. So yeah, we won't probably be very useful for you from that perspective if you kidnap us. Yes.
Yeah, pretty much similar thoughts. Enablers were definitely not, a company that's looking to kind of become a unicorn, though we're backing early stage startups. Our thought process has primarily been not to kind of push companies to become unicorns per se, but to kind of achieve critical
That's a very
size.
important thought,
Yeah.
please expand on that, Karan, a bit, that what's more important, like to become a unicorn or to become like a company with profits on their charts, or with the company with, say, impact on their charts?
So I think all the companies that we've backed so far, there's an impact angle, and we'll touch upon that in a bit. But first and foremost, most important aspect for us, from a fund perspective, is obviously to allow these companies to grow and give, get exits and give returns to our investors. But having said that, all the companies that we've backed are, unit economics positive. They make business sense. They have viability, on ground viability, that we feel that even if they're not able to raise, let's say $1 billion in capital, they will survive and they'll create a sustainable business for the long run. So the idea over here is obviously to allow them to grow to a particular critical size that makes it very attractive for, let's say, larger businesses, or let's say they become certainly attractive in such a manner that larger businesses start paying attention to these segments or sectors that they have ignored for so many years.
That's an interesting perspective. But now, I like to switch the gears to please explain that how is, say, climate finance or investments linked to reversing climate change?
Do you want to go first?
Please go
Sure,
ahead.
happy. The basic thing is we need new solutions, new innovations to address what we're facing on climate change. Our focus so far has been around mitigation, which is reducing climate GHG emissions. And how are you actually going to get these innovations scaled? One of the key things about any sort of climate innovation is that it's replacing something that's already there. So you have a solution, think of EVs replacing ICE, any sort of energy efficient instrument replacing something else which is more energy consuming. But the fact is, you have to get past this barrier of a person who already owns something wanting to purchase something, and also you're dealing with companies who are at an early stage. So what climate finance really is doing is to kind of sort of making those playing field more accessible so that adoption can happen faster. There's obviously two angles to this. There's the whole innovation angle of how do you actually invest in solutions, because we are fundamentally very often talking about physical products which need a lot of time for developing. They're asset heavy. We've never really had a great culture of hardware and asset heavy innovation in India, but it's changing now, led by the EV space. And all of that takes a lot of capital. But the basic thing around which we just distill what a climate solution is that you're replacing something that's already there. And to get that adoption happen faster and to happen quickly, you really need the sort of capital to, sort of working capital, which allows you to maybe give some concession towards what to selling to a customer. Or it could be the sort of capital which allows you to invest further into making that technology that much better so that you have a customer who purchases it. So at least that's how we see, what climate finance can really do, and why we are very bullish that this is probably going to be one of the biggest forms of financing going forward for the next few years.
And with Karan, in your respect, that how is, say, smart mobility, like how is this going to scale? For example, how are we going to make EVs accessible to a tier 2 or tier 3 cities?
It's already happening. But so let me kind of, backtrack a bit. and how do we kind of help these companies, or what's our real role here? To be honest, larger organizations all have, they may all have a climate angle or CSR activities that they're doing, but innovating at ground level, trying to replace, as he said right now, is a very difficult kind of situation. In order to that, you have to kind of create a brand new product for large, let's say, auto manufacturers, etc., to make economic sense. They have to produce 50,000 vehicles a month at least. I mean, they have to get a complete line set up, and that is not viable when you're just trying to innovate or create one single new product. And that's where we really come in, and we're able to assist early stage companies by giving them a little bit of capital in order to help them create that product. And once that product is created, and they have IPs around it, and it starts replacing the existing products on road, that's where we see that there's going to be a climate change. And you can already see it, right? I mean, I think we're close to about 1 million two-wheelers that's already been sold, in the electric vehicle market. Though it's still a small number from the entire ecosystem, but two-wheelers. So one of the companies that we've invested in actually helps increase adoption for two-wheelers, and it's city agnostic, doesn't matter, right? The problem with electric vehicles has typically been the higher upfront costs and the lower per kilometer costs. So nobody wants to make heavy payments upfront, and since specifically in the two-wheeler space, the category that that utilizes these vehicles the most, they don't want to make those kind of down payments. But if you get a subscription model, it increases adoption. So increasing adoption is the key, allowing people to start shifting their focus from running ICE vehicles to moving to electric vehicles.
I think it's actually similar to what you were also saying, that making people adopt that technology, or in your case that EV. Also, like Karann, like in the EV space, like from my understanding, and I might be wrong, that there are different areas to work on. It could be infrastructure, the battery swapping systems, charging stations, and technology, BMS and stuff. So how is the investment, current situation in the EV sector today?
It's pretty interesting because we're looking at each and every segment of this, and we're looking at it, let's say, in a deconstructed form. We're not looking at it from a holistic piece that, there's this one two-wheeler manufacturer who's developed everything. Because we believe that expertise, you really need expertise in each and every product, whether it's the drivetrain, the motor, or the controller, or it's the battery that goes into these vehicles. In fact, you'd be surprised, electric vehicle tires wear off quicker than the normal tires. And there is some amount of innovation that's needed there, but we haven't come to that as yet. But what I'm trying to say is that, having said that, this is the entire ecosystem that needs to be developed simultaneously. Therefore, we are looking at it from a deconstruct and each segment or component is very interesting from an investment standpoint. And most of the investors are looking at it from that segregated manner and not from a holistic standpoint.
Because ultimately for the ecosystem, like for this to have like an adoption, we need to have the entire ecosystem ready with us. Because if, say, someone has an electric vehicle but there is no charging stations around his house, so like I think I understand what you're saying. So Shravan, coming to you, that you told me about like the way you are actually enabling these farmers. One of the important things I've always felt is that we always say that there's a group that's more vulnerable to climate change.
Yeah.
And what I feel is that there could be two approaches. From the top down approach, where say EVs and everything, but the other could be a bottom up approach where you're actually enabling these people to be warriors rather than like you understand what I'm trying to say.
Yeah.
So I want to understand that how can finance, how can capital help us enable these people?
Sure. So when you look at, and this is very specific to the agri-tech space, which is something we're going to be focusing a lot more into going further down, because it's such a microcosm of so many things. People in the farmer producer organizations, direct farmers, they're in the forefront of the change that's happening. And also the fact that agriculture involves a huge amount of emissions which need to be mitigated. So one of the ways, and look, we have tried to do off-grid, solar for like the last 20 years. Adoption is not really picked up. So one of the biggest changes that we have been seeing is around this area around productive use. So productive use, decentralized renewable energy, DRE, and which basically we're just trying to show and create additional incomes through the use of, say, these cleaner, more alternative forms of you know alternative forms of energy being driven and using machines. So we're basically in this space wherein we're trying to enable them to be warriors and go on this shift by providing them the tools and the machinery and the capacity for them to do that. But because they are, farmers who are economically weak most of the time, what financing does is really to make it affordable and more accessible. I can give you a case of where we do a lot of work on asset finance, which basically looks around how do you, just make products more accessible, so that rather than paying a huge upfront cost, you can sort of align it towards, the sort of cash flows that a farmer can work with. We work with providing them with a solar dehydrator, which is a really interesting product because it reduces food loss. It extends the life of produce, which can then be sold to markets, and they're basically creating higher income for them. So the main way that we think that this has to be done is how do you actually increase incomes, increase livelihood opportunities for them. With that capacity, there's a lot more things that can be done. I remember there's one case of one specific farmer who was supported through this with just initially using one solar dehydrator. She then had more income to actually start installing more sorts of, off-grid solar on her own, so that her house was powered better. So it becomes this sort of like cycle wherein more additions can happen. But for us, it really starts from the root that how can you increase livelihoods by also matching this, so that they then have the capacity to actually access things more. So I think financing the first step is really financing those sort of instruments that allow them to actually get to that stage.
I think I read it somewhere that the affordability and accessibility of the finances would really define that in our transition towards, a low carbon economy or a climate resilient economy, the inequality gap will actually widen up or it will close.
Absolutely. If you look at, we run behind this number very often about how our per capita emissions is like a quarter of the world's emissions. You break that on in income segments. India's top earning population is like 9 times more than what the lowest income is, and that's easily, I think, 4 or 5 times above the global average. So we never account for them from an inequality perspective. And one of the things that we've started seeing as well is how solutions have to be catered towards different segments of the population, and how that has to be focused on your very correct point on really bridging inequality in some way. So how can a particular solution help them to actually scale up and slowly advance along so that they can become more aspirational and access more things? So it needs targeted solutions at both ends.
And Karan, have you seen any such stories in smart mobility?
So I think financing per se is an extremely important aspect for mobility, specifically because consumer adoption for vehicles has been lower compared to fleet adoption, and we really don't have financing solutions specifically, or banks, or let's say the mainstream finance or the lenders don't have solutions to finance fleet, because they're basically finance on receivables versus the asset per se, or other their income. So having said that, from an overall basis, there have been a number of kind of push from a lot of angles to kind of get this into the priority sector lending format, etc., so that financing can be available, which will obviously accelerate adoption again. It's all a function of that. I mean, we all have limited time for climate action, and financing plays a key role, though, and specifically debt. It's not only equity, but the coupon at which the debt is actually provided is so high, it still would not make viable sense for low income groups to kind of come on and take up these vehicles.
I think that's a very interesting point, and I
Yeah.
think Shravan would have a lot to say. And just adding to your point, I actually read एक report जो आई थी कि how नीति आयोग की कोई रिपोर्ट थी कि आरबीआई को क्यों शुड इंक्लूड दिस थिंग इनटू प्रायोरिटी सेक्टर लेंडिंग, the EV thing. And usme it was mentioned that, for example, a lot of people could not adopt electric vehicles, specifically say the e-rickshaw segment, or because they have to keep a collateral to purchase that vehicle. And even, for example, if there is a bus operator who has like a fleet of buses, so how is he going to do that? Because many times they do not have like a very high collateral to keep upfront. So what do you do in that case? And in the impact numbers, I think smart mobility has impacted, like the drivers' lives have become easier. The e-rickshaws, like now they don't pedal in the summers. How easy their lives have become with this mass adoption.
Yeah, you'll be surprised with our portfolios. We've actually, impacted more than 200,000 lives in over the last few years. And in terms of, CO2 emissions, we reduced, we've kind of reduced about 500,000 tons of CO2 emissions just by, increasing efficiency, increasing, let's say, adoption to electric vehicles. It's, and the way we've kind of done it is just, equitable kind of calculation, whether an ICE vehicle would be running instead of a, EV, or a EV is running instead of an ICE vehicle. It's because the vehicle is anyway going to run irrespective. We're seeing every segment. Deliveries increasing, last mile deliveries, mid mile. Your e-commerce has increased over the last number of years. So all this is actually, tend to, rely or have a backbone of logistics.
Before we move to the debt sector, Karan, I have like a little, question for you, that in EVs, whenever we talk about, say, sectors, हम लोग ज़्यादातर सुनते हैं logistics, two-wheelers, three-wheelers, or in the consumer segment. But how is the truck segment going to look like? Do you have like any investments in that sector?
Not as yet.
And why is it so? Like ऐसा है कि companies नहीं है, या फिर मतलब challenge क्या है उसे? Because trucks बहुत बड़ी market है, I think, in the coming years.
So electric trucks is definitely an interesting market. It's, we look at it from a long haul perspective. The running of the vehicles is important. One, for electric vehicle or electric trucks to run across the country, you need a substantial charging infrastructure base. Over and above that, there can be alternative fuels that actually make sense for such large vehicles rather than, the size of battery that is required for electric truck. Now, and having said that, a small fund like ours with limited capital, I don't think we can seed a company that has is going into making electric trucks, because the size, the volume, and etc. required for creating that company would be far larger. But yes, very limited. We haven't seen. We probably would have seen almost every, let's say, mobility company across the country so far. But we haven't seen, we've seen a couple, but not too many in the electric truck space.
There's an organization called Evolve. I don't know if you've heard about it.
Yes, I have.
So, like, they have built this platform. Arham has built the platform. That's basically India's first digital platform for EV trucks, and they're trying to solve like logistics through that.
So, right now, EV trucks per se, depends on the size that you're seeing. We haven't yet even seen the 407 size. Yeah, the 407, the big ones. The trucks that right now with payloads are about, 1.5 tons. We haven't seen anything. We haven't yet gone into bigger vehicles as yet. I'm certain that we will, but it's just a function of time. And infrastructure, everything collide, or let's say, comes together to allow that business to work.
And coming to you, Shravan, that please explain like how is debt going to play an important, like debt financing to be specific, going to play an important role in accelerating this climate ecosystem?
Sure. So it goes back to this one point that most climate assets, at some point or the other, they're going to be reliant on physical assets. And debt is an amazing instrument when it comes to, either from a B2B perspective, you have a purchase, you have a certain order that you have to be financed, something based on working capital. It can just be a more accessible form of capital that you can do. And it just opens up so many more layers and ways to just tap into financing, because what we have seen, say, right from the solar space, that today solar financing is driven by debt. And what I think the aim that we want
Is it a
is
success story like the solar financing driven by
absolutely.
debt?
But the thing is that took 20 years. What we want to do is, can you make it happen in other sectors? But we don't have 20 years. So I think one of the things that we need to look at from what's happening with, debt is going back to Karan's point that it is expensive and it is probably unviable for a lot. So how do we actually make it more accessible? One of the basic problems we have is cost of capital is high. And so how do we tackle cost of capital? So we have platforms like GCF tying up with SIDBI to offer, low cost interest loans. But more than anything, you need schemes like credit guarantee schemes come in, especially in sectors like agriculture, where there is such vulnerability, traditionally super high risk beneficiaries. But these need to be financed because your breadbasket and so many things are reliant on this, and it is, we keep repeating the stat, it employs half the population of the country, and this is a sector which is going to feel these effects first. So how do you actually start making instruments accessible and relevant towards what the sector is? One thing is definitely our hands are tied as long as cost of capital is high, but there are ways in which we can sort of figure out and see how can you actually make it more accessible. And this whole idea of credit guarantee schemes, for example, is a way to that. I know Tata has a program called Sustain Plus in which they help to provide, and it's not even in agriculture, it's anything in the rural peri-urban area, the adoption of assets there, and they work with startups who are looking to deploy these instruments at a fairly significant scale, so that it kind of works backwards, that this is the first big order, increase economies of scale, your next batch is going to be more affordable and accessible. So I think at this very basic level, it has this capacity to really scale in many forms, and it just becomes more accessible to just get into it. But one of the things, again, going back to Karan's point, is we need to figure out what sort of debt instruments actually start working for different sectors.
Actually, what he says is absolutely correct. To be honest, we've seen a few credit guarantee players come in for the electric vehicle space as well. The problem, the cost of capital is so high that the moment you add a credit guarantee scheme cost to it, which is a few percentage points, the viability changes. So, I mean, that has to be balanced. It's a difficult situation, but until you balance that, neither is going to kind of benefit from it.
And please do explain about the solar debt financing model.
So,
and what are the learnings from that could be, say, applied today?
So I think, one of the things that we found interesting with the ability to access debt financing, especially in solar, it just created this opportunity of different sorts of models that you could deploy. You found out that, I could be a developer, I could access debt, and then I could basically do this sort of like, I could just, I wouldn't have to require my customer to purchase it directly, but then just be able to do this pay-as-you-go sort of model, so that then I'm able to have this multiplicity of business models around it just by having access to capital to front-end the sort of infrastructure cost, because that's obviously going to be the main cost that comes into the play. So I think that's what's just the ability to have capital, just the fact that you can have this capital and then you can design business models around it, because it gives you that sort of runway to do something further. That's at the root and the basis of what that can really offer. So I think that for us is what we want to start seeing in other sectors, because you want to get forms of, the easiest way you're going to make things accessible is not making the entire cost of a expensive climate asset, make a customer have to purchase that upfront. You want to basically break it down. Now the choice is, do I want to make that customer be the one to sort of bear the cost of buying it on a EMI basis, or do I, as a startup who's running this, do I want to eat up that cost, but then I deploy it in a sort of like in a subscription type model towards an end user? I get options. And I think that's what is really interesting when you look at solar today, just on the back of what access to capital is offering. You have companies like Sunday who, they're doing that biscuits model, which almost is crowdsourcing the ability for you to actually get, build solar, rooftop solar. And you have, right from large scale players to smaller scale players, just such a multiplicity of options. And that's basically, I think, has been the real success story that's come out of the solar.
Do you have like any such instances from your background in this smart mobility space?
For specifically? Yeah.
for, like specifically for the way he's mentioned that, the way we break down the cost for the consumer. Like, have you worked on some business models trying to figure
So
out?
our portfolios are already doing that, and that's the only way to actually increase adoption. To be honest, because once you operate in fleet, the riders, or let's say, like our portfolios are tied up with Swiggy, Zomato, Zepto. All the riders are getting these vehicles on, let's say, weekly or bi-weekly, monthly basis. So they've already broken down the cost for them and not allowing them to purchase it, maintaining the asset. And that's actually how one of our first companies started operations, which is pretty interesting, because people were unwilling to buy the vehicle. They started with L3 vehicles. People were unwilling to buy these vehicles because they didn't understand, how this asset would perform, what is the life, what is the residual value. There are multiple facets to this. So they started operating these. They gave it out on lease, with the driver on a monthly cost, and when they started running for a few months, is when people started purchasing these assets, and there were other asset management players that came into the fray that took up these assets to run them, because they realized that itself is another viable business model. And so breaking down the costs for let's say the last end user is definitely an option. It's definitely a viable play.
And how do you stay, current relevant in the industry? Because EV space may all the big players are, bringing out their products. It could be from Tata to Suzuki to any big player you talk about today. And then there are startups, some amazing startups also working. So do you feel competition hoga aage jaake? And can these startups survive? Because what I see is that the bigger companies, they have got ample amount of cash for R&D.
They had ample amount of cash for so many years.
So how are startups going to, survive in this space? For example, we'll come back to this question after, when you answer it. Abhi we saw Shark Tank. And Shark Tank pe there were so many, these electric companies. So, and all over the country these companies are coming out. So how are they going to survive in this,
So I
thing?
think one of the key ways that they will survive is through IPs, intellectual property, and technology that they build within their product. Now, whether it's within the battery pack, whether it's how cell chemistry is, how you kind of combine the cells, what kind of motor technology, what kind of efficiency those motors run on, how do you tweak the entire technology within those components, is how they will stay relevant. The other thing is how well you actually understand this asset. So the amount of, now, if you really look at it, the entire, let's say, digital, or let's say startup ecosystem is built on data. We've got a lot of data. Earlier we used to use customer data for sales. Today we'll use the same kind of data, the vehicles data, their movements, in order to understand these assets, predictive maintenance, preemptive, able to understand what kind of parts, reduce breakdowns. There are so many aspects to it. This is how these players are going to stay relevant. It's the algorithms that they will write that allows them to, on these data sets that they receive, that they're able to predict how, to manage these assets.
And I think it goes back to your point that the way the ecosystem evolves is like these levels of expertise are going to come at each and every point. Yes. That it's no longer going to be just like one big behemoth doing everything. Yeah.
And to your second question, in terms of what's going to happen with the bigger players, I think there's always a phase of consolidation. And I think that's going to be key, because they'll realize that it's difficult to build everything in-house. It's not possible, and doesn't make sense to build everything in-house. So rather, let's acquire, some of these companies who've reached critical size that can actually integrate with our, kind of technology, or let's say our manufacturing lines, and they can, kind of set up their own units then.
Definitely. And Shravan, like coming back, I also read your report on the climate finance, and it was like a very good read. One of the points that really caught my attention was the methane thing. So my point here is that when we are looking towards investing, or say when you are looking towards, investing in these spaces, how do you define कि इस पे invest करना है, इसमें नहीं करना? For example, the one thing and please explain the methane point you mentioned in the report, that how if we could work on methane,
You could
probably
actually
we
have a
can
big
have
impact.
like a
Yeah.
gooder impact in probably lesser period of time, and the impact scale could be higher. So how do we decide that ठीक है, इस पे invest करना है, इसमें नहीं करना है?
Absolutely. And coming the first point, like why is methane so important? Methane basically has something like 86 more times heat warming potential than carbon dioxide, which means greenhouse effect is trapping heat, sending it back. 86 times of more heat is trapped in methane than it is in carbon dioxide. So there's just that much more. And the second thing is that ultimately these molecules dissipate. All these greenhouse gases, they break into constituent forms. Carbon dioxide takes hundreds of years, methane takes place in 10 years. So if I'm emitting methane today, it'll only last in the atmosphere for 10 years. So if we basically cut down 30% of methane by the next 10 years, by 2040, that amount will no longer exist in the atmosphere. But that's not the same with carbon dioxide, because that's still going to be in the atmosphere going forward. So there's a big pledge called the Global Methane Pledge, which has come out. The aim is for reducing methane emissions by 30% by 2030, so 30 by 30. And it's even been predicted that, just by doing this 30% reduction, we can reduce that global temperature increase by something like 0.3 or 0.4 degrees, which when you look at 2 degrees being on course for it, that's a significant amount. You can think of it as being almost 20% of what our reduction is going to be. So that's why methane is super important, super critical. Now, the problem with methane is the sources of where it comes from. It's largely livestock, it's largely rice paddy, and rice paddy is, but growing rice and cultivating rice is not an easy process to really interfere with, because it's expensive to do other forms of growth, like alternative wet drying, which is a form of rice which reduces the amount of water used, reduces the amount of methane generated, and you also have the issue with dairy and cows and all that stuff. So the problem now becomes, how do we create focus that this is the sector to tackle? And we get asked this question quite a lot by VCs, that what are you bullish about? And I do give an honest answer by saying that what I feel has to be addressed may not be what you are bullish about. So this is a very common thing. So and so the thing comes down to, how do we make the case for something like methane to happen? That's still something, because when you look at a significant amount of this relating to smallholder farmers, immediately the usual things about that come up. It's a market which does not have much capital to spend. You cannot go, if you are able to even get them to adopt directly, scale does not happen easily. So there's actually a really interesting company we have been working with, which is one of the few companies, and if you kind of have worked with the agri space, what they've done is quite interesting, by getting larger companies like your ITCs, larger conglomerates, to purchase their services and not get farmers to purchase the services. So, because generally when you look at a lot of agri-tech, you'll sell it to a farmer, you'll sell it directly there. And there's always this cost of, it'll work for a couple of years, then it won't get adopted. But they've been able to, and their main innovation has been a business model innovation. It's, while there's technology, they also do have like core technology that they've developed. It's very interesting, really useful. For me, the most amazing thing about them is getting a big company to pay for what they do. That is astounding. So we need to start seeing about how do we create the case that this is actually what has to be picked up, and who are those players who can make a change, which ultimately comes down to incentives. And how do you demonstrate that these incentives are key is really what's going to make or break. And before the show, we were talking about the right place at the right time, and a large part of whether a technology is successful is based on the incentives of the people who can make it happen.
I think replicating these success stories across India in different areas could be like an amazing, because how many people get to know that, okay, this is also a way that you can actually, work with these companies. So the last part would be that, what do you feel about policy? Do you feel that Indian policies today are supporting the climate growth, today are supporting the climate finance ecosystem?
So I think the government has been pretty, proactive for electric vehicle policy, and they've been, humongous subsidies have been provided for increasing adoption, which I think is fabulous. But the thought process, from an investment perspective, has always been that don't build a business around subsidies.
Yes.
But having said that, the government has tried to push, and it has been on the agenda, which is excellent. It helps drive, let's say, people towards the sector. Also, it gives confidence that yes, it's not going to kind of just vanish tomorrow, which is more important from anything else. Like if there's an agenda, if there's a government agenda, then we're clear that yes, this sector is here to stay, and not it's not going to just disappear overnight.
Yeah. And I think a good example of that is at least something we have seen around EPR and plastics and just the waste sector in general, especially if we take plastics and electronic waste. And see, because what EPR really did was put the onus on companies to take action for some sort of change. The initial forms of these policies were very confusing. There were many ways to show you were doing impact without really doing any impact. But what we've seen in the latest avatar is very clear policies which really incentivize some really strong innovation to happen in the ecosystem. So where now packaging has to have a certain amount of recycled content, that is going to require a brand to basically go to the bottler and say, can you do this? What is it going to take for you to actually get this done? And that then also has to go back to the people who are doing the recycling to do it at a higher quality. And I think for us, the role that how policy has played in plastic waste especially has been really interesting. It's been really good because it's not just a case about defining policy, it's enforcement. They have been a bit draconian at times about it, but ultimately it's come to this stage that we are seeing amazing focus, investment, innovation happening in both the e-waste and the plastic space. And I think what's most interesting is initially a lot of this thing was around the waste collection and segregation parts. We're getting to the other end of just better recovery, better recycling, so that we're making more circular products. So for us, we always refer to what is EPR today as a good example of what policy is actually enabled.
Definitely. Thank you guys. Thank you for being on the show and thank you for sharing your insights. It was wonderful to have you guys and thank you so much.
Thank you so much.
Thank you
Really
for having
appreciate it.
us.